If you're planning to buy a house or a condo, rental property, or any other type of real estate, odds are you're going to need a mortgage. And this is the biggest financial commitment most people ever make. So it's important to understand how mortgages work before you jump in. Here's what you'll need to know. Most home buyers put some of their own money toward their home purchase, and this is the down payment. Then they cover the rest of the sales price using a mortgage loan. That loan amount is paid off at monthly intervals, often over 30 years. Your down payment, loan amount, loan term, and interest rate determine how much house you can afford, how much your monthly payments will be, and how much interest you will have paid by the time your home is paid off. Mortgages come in lots of shapes and sizes, but most home buyers use the same general loan type, which is a 30-year fixed rate mortgage. One important thing to note is that taking out a 30-year mortgage doesn't mean you're going to be committing to living in your home for 30 years. You don't have to keep the loan until the end date and pay it off in full. In fact, most homeowners don't. They either sell or refinance their home before their mortgage term is up. I don't want to dive too deep into loan programs, but there are 4 main programs: conventional, FHA, VA, and USDA. To qualify for a mortgage, you must meet the minimum standards of whichever loan type you determine is best for your needs. Each loan type is different with varying qualification standards, but the steps to get mortgage qualified are similar among the 4 programs. They will look at your credit score, your work history, debt to income ratio, assets and debts, down payment, and closing costs. They will ask for a variety of forms like your W-2 or 1099, pay stubs, bank statements, driver's license, and social security number. Now there's a lot to unpack there, but I'll describe everything in the details below. Regardless of what company you choose for your mortgage financing, it's vital that homeowners compare apples to apples with regards to rates and fees. If your primary objective is to simply get the lowest closing costs and lowest rate, compare rates and closing costs on the same day. Interest rates and fees change. Shop around with different lenders to see which one works best for you. And something to note is that the credit bureau gives you 45 days from the start of your first credit pull to continue shopping with other lenders. Keep in mind that a lender is not a financial planner. Their job is to give you your max approval amount. They may give some advice, but seeking a financial advisor is a good idea. It is best to take into account all of your spending per month and gauge if the max purchase amount is something that you're comfortable with. This is a broad overview of what lenders are looking for when you're shopping for mortgages. Thank you for watching, and I hope you learned something new.